On January 30th, 2026, the silver market did something it had never done before. Over the span of about 30 hours, it plunged by over 30%, with intraday losses hitting as high as 37%. Billions of dollars in investor capital, built up over months of euphoric buying, were wiped out in a matter of hours. This wasn't a glitch, a random fluctuation, or a simple correction. This was the violent end of a perfect storm, a textbook case of how modern markets can break. In a moment, silver, the asset that had been on a seemingly unstoppable tear, simply died. This was no accident. It was a forensic event, a chain reaction where three distinct, powerful forces collided at the exact same time, creating a domino effect of pure financial destruction. If you've ever invested or ever watched a position turn against you with terrifying speed, then this story is more than just history. It's a critical lesson in the hidden mechanics of the market, and right now we're going to conduct a full forensic autopsy. We'll dissect the event moment by moment to show you exactly how it happened, why it happened, and what it tells us about the financial world we operate in today. To really understand the violence of the collapse, you first have to appreciate the euphoria that came before it. The run-up in silver throughout 2025 and into early 2026 was nothing short of breathtaking. After starting 2025 near $30 an ounce, the metal went on a relentless parabolic rally. By late January 2026, it was smashing through record highs, touching levels above $120 per ounce. The market was electric. The story driving this surge seemed bulletproof. First, there was massive industrial demand. The global push for green energy created an insatiable appetite for silver and solar panels, while the explosion in artificial intelligence and electric vehicles added even more pressure on supply. Second, central banks were buying precious metals at a historic pace, desperately seeking a hedge against global instability and their own monetary policies. And finally, maybe most powerfully, was the fear of US dollar debasement. With government debt spiraling, investors piled into silver as a classic inflation hedge, at tangible store of value in an uncertain world. Sentiment wasn't just bullish, it was ecstatic. Analysts were falling over themselves to raise their price targets. The consensus was clear: silver was going to the moon. But as history teaches us, the most dangerous moments in a market are often when everyone believes the same story. While everyone was looking up, dreaming of higher prices, three powerful forces were converging just beneath the surface, preparing to unleash a tidal wave of selling that would catch the entire world off guard. The stage was set for a catastrophe. The event that lit the fuse wasn't an economic report or a market development. It was a political announcement. On the morning of January 30th, 2026, President Donald Trump announced his nomination for the next chair of the Federal Reserve, Kevin Warsh. To the average person, this might seem like dry political news, but to the financial markets it was a bombshell. The entire precious metals rally, especially the dollar debasement trade, was built on one key assumption: that the Federal Reserve would continue on a path of easy money, maybe even cutting interest rates aggressively. The market had been anticipating a dovish nominee, someone who would be open to lower rates, which would in turn weaken the US dollar and make non-yielding assets like silver more attractive. Kevin Warsh was the exact opposite of that. Warsh, a former Fed governor, had a well-established public reputation as a hawk. In central banking, a hawk is someone primarily concerned with fighting inflation, often advocating for tighter monetary policy, meaning higher interest rates and a stronger currency. He was known for his warnings about inflation and his calls for the Fed to maintain its independence. The market's reaction was instant and brutal. The nomination of a hawk shattered the expectation of endless easy money. It signaled a potential pivot toward a stronger, more stable US dollar. The US dollar index, which measures the dollar's strength against other major currencies, surged on the news. This had a direct and devastating impact on silver. Because silver is priced in US dollars, a stronger dollar automatically makes it more expensive for foreign buyers, hurting demand. But more importantly, it was a body blow to the entire narrative. The fear of dollar debasement, the rocket fuel for the silver rally, evaporated in an instant. As one analyst noted, the Warsh nomination was the excuse markets were waiting for to unwind parabolic moves. That single announcement completely rewired the market's expectations. It was the policy shock that turned the tide. The first domino had fallen, and it was a big one. But this was only the beginning of the cascade. The fear sparked by the Fed news was about to collide with a hidden tripwire in the market's plumbing, turning a panicked sell-off into a forced liquidation. As the Fed news sent shockwaves through the market, the price of silver began to fall. But what happened next had nothing to do with policy or sentiment. It was purely mechanical, driven by the rules of the financial game itself. The exchanges, the very marketplaces where silver is traded, stepped in and turned a bad situation into a catastrophe. They aggressively hiked margin requirements. To understand the destructive power of this, you need to understand leverage. In the futures market, investors don't pay the full price for an asset. Instead, they post margin, a small fraction of the total value, like a good faith deposit that lets them control a much larger position. For example, a 5,000 ounce silver Futures contract worth over $600,000 at its peak might only require a trader to put down around $50,000 to control it. This leverage is a double-edged sword. It magnifies gains on the way up, but it magnifies losses with terrifying speed on the way down. As the euphoric rally in silver had progressed, the market had become incredibly leveraged. Speculators had piled into futures contracts, using borrowed capital to chase the momentum. When the price started to fall from the Warsh news, these leveraged players found themselves in immediate trouble, and this is where the exchanges delivered the killing blow. Citing the spike in volatility, exchanges like the CME Group announced they were raising margin requirements. They had already shifted to a percentage-based system, and in the wake of the crash, maintenance margins for silver futures were jacked up significantly. This meant that every single person holding a silver futures contract suddenly had to post more cash to maintain their position. This triggered a wave of margin calls. A margin call is a demand from a broker for an investor to add more money to their account to cover mounting losses. If the investor can't or won't deposit the funds, the broker has the right to forcibly close their position at whatever the current market price is. They sell whether the investor wants to or not. For the thousands of leveraged silver bulls, this was a death sentence. They were trapped. They had to either come up with huge amounts of cash immediately or be forced to sell into a market that was already plummeting. This created a vicious, self-reinforcing doom loop. The initial selling from the Fed news triggered margin calls. The forced selling from those margin calls pushed prices down even further and faster. This, in turn, triggered even more margin calls, leading to more forced liquidations and creating a waterfall of sell orders that overwhelmed the market. This wasn't a choice. It was a financial death spiral, a mechanical process of liquidation that fed on itself. The market was now in a full-blown financial squeeze, and a third, final factor was about to ensure there was no floor to be found. The third and final piece of this perfect storm was the chart itself. Long before the Fed announcement or the margin calls, the technical indicators for silver were screaming danger. Professional traders, hedge funds, and especially the algorithmic trading systems that dominate modern markets had been watching the price action with growing unease. The primary warning sign was that silver was deeply overbought. A common tool used by traders is the Relative Strength Index, or RSI, which measures the speed and change of price movements. A reading above 70 is typically considered overbought, signaling that a rally may have gone too far, too fast, in the days leading up to the collapse. Silver's RSI had soared well past that level, a clear signal of extreme overextension. The shape of the rally itself was another major red flag. It wasn't a steady, healthy climb. It was a parabolic curve. Prices were going up at an accelerating rate, a pattern that is almost always unsustainable and often ends in a sharp, violent correction. The market wasn't just bullish. It was in a state of speculative mania, detached from its underlying fundamentals. For technical analysts and quantitative funds, these weren't just interesting observations. They were actionable signals. Many had pre-programmed stop-loss orders set at key technical levels below the market price. A stop-loss is an automated order to sell a position once it hits a certain price, designed to limit potential losses. Key support levels, price points where the market had previously found buyers and bounced higher, were identified. These levels acted as a line in the sand. As long as the price stayed above them, the uptrend was intact. But if they broke, it was a clear signal to get out. When the Fed news hit and the initial selling began, the price of silver sliced right through these critical support levels. This was the final domino. The moment those technical levels were breached, a chain reaction of automated sell programs was triggered across the globe. Algorithmic funds, which make decisions based on price levels, not human emotion, began to dump their positions. Technical analysts saw the break as confirmation that the trend had reversed and joined the selling pressure. The stop-loss orders that investors had placed for protection were executed, adding even more fuel to the fire. This is the anatomy of a modern market cascade. The policy shock from the Fed created the initial push. The financial squeeze from the margin hikes forced leveraged players to sell, and the technical breakdown provided the clear signal for systematic and algorithmic funds to liquidate their holdings at any price. The floodgates were now wide open. This is the point where the three forces, policy, leverage, and technicals, merged into a single, unstoppable torrent of destruction. It was no longer three separate problems. It was one catastrophic, self-reinforcing feedback loop. Let's retrace the sequence of destruction. It started with the surprise nomination of a hawkish Fed chair, which instantly repriced market expectations and started the first wave of selling from those fearing a stronger dollar. That initial price drop was sharp enough to break through long-held technical support levels on the charts. That break acted as a tripwire, unleashing a tsunami of automated sell orders from algorithmic funds and triggering stop losses across the market. This sudden, computer-driven plunge created a massive spike in volatility, and that spike gave the exchanges the justification they needed to issue their punishing margin hikes, dramatically increasing the cost to hold a leveraged position. Those margin hikes led directly to margin calls on an epic scale. Speculators who were long and wrong were forced to liquidate their positions to meet the calls, selling their silver contracts into an already collapsing market. This forced selling pushed prices down even further, which in turn broke the next level of technical support, triggered another round of stop losses, and led to even more margin calls. This was the doom loop in full effect. Every stage of the collapse fed the next, accelerating the decline until the market structure itself began to buckle. Liquidity evaporated. For every seller, there were fewer and fewer buyers willing to step in front of the freight train. The price didn't just fall. It gapped down, dropping through the void as the bids disappeared. What investors experienced was not an orderly market but a complete breakdown. In just a day, this vicious cycle had turned a bullish darling into a toxic asset that everyone was desperately trying to sell at the exact same time. The perfect storm had made landfall, and the devastation was absolute. In the span of a single day, the silver market was fundamentally broken. Billions in capital had been erased. Spot prices plunged from over $120 to near $84. Silver futures fell over 30%, the steepest drop since 1980. Leveraged ETFs designed to track silver fell by as much as 60%. The euphoria was replaced by shock, fear, and catastrophic losses. In the days that followed, the price would eventually stabilize, but the psychological damage was done. But as brutal as this event was, it provides invaluable lessons for every investor. First, it's a stark reminder of the awesome power of Federal Reserve policy. The old adage, "Don't fight the Fed," was proven in the most painful way possible. A single announcement, a mere change in perception about interest rates, was enough to completely reverse the trend of a global asset. Second, it's a visceral lesson in the dangers of leverage. Leverage can create incredible wealth on the way up, but it can and will destroy you on the way down. The margin calls that forced investors to sell weren't a suggestion. They were a demand. Understanding margin and the risk of forced liquidation isn't optional. Third, this collapse highlights the critical importance of market structure. The interaction between technical levels, algorithmic trading, and exchange rules is a hidden force that can override fundamentals in the short term. The fact that the physical market for silver remained tight while the paper market in New York and London was imploding shows just how disconnected the two can become. The crash was a paper event, a liquidation of leveraged bets, not a reflection of a sudden glut in physical metal. Ultimately, the great silver collapse of 2026 was a story about how narrative mechanics and psychology can collide. It teaches us that no asset is immune to gravity, that parabolic moves often end in tears, and that the moments of maximum euphoria are often the moments of maximum danger. The anatomy of this collapse is a case study that every serious market participant should burn into their memory. It's a blueprint for how a bull market can die, showing how a policy shock, a leverage squeeze, and a technical break can combine to create a chain reaction of financial ruin. Understanding the mechanics of past crises is one of the best ways to prepare for the inevitable volatility of the future. And that brings us to the critical question: could a perfect storm like this happen again? Are there assets right now displaying the same warning signs of euphoric sentiment, extreme leverage, and overextended charts? Let me know your thoughts in the comments below. I read every single one. If you found this breakdown valuable and want more in-depth financial analysis that cuts through the noise, take a moment to subscribe to the channel and turn on notifications. It's the best way to stay informed and ahead of the curve. Thanks for watching.